All right, let's jump right into this explainer. If you're an investment professional managing capital right now, you already know we are in the middle of a massive structural shift. We are aggressively moving away from passive digital intermediation, and we're heading straight toward an era of autonomous, programmable value. As capital allocators, we've got to cut straight through all that meme token hype and the noisy headlines. You really have to ask yourself, is your portfolio actually ready for an era where capital isn't just digital, but actively self-allocating? Because we are talking about a fundamental reset in capital markets, where the cost of capital demands real sustainable profitability and serious unit economic discipline. To get there, we'll quickly run through 6 critical areas: the new financial frontier, digital assets and tokenization, blockchain in real markets, the rise of agentic AI, fintech and cross-border settlements, and finally, navigating risks and regulations. Starting off with Section 1, the new financial frontier, transitioning to programmable value.
Look, fintech sector revenues are projected to grow 3 times faster than traditional banking through 2028. It's wild. Our financial ecosystem is branching out rapidly. We're moving from the old familiar trunk of public fiat and private bank deposits right out into new branches like private tokenized assets and stablecoins operating on distributed ledgers. The very nature of what we consider a secure transaction is fundamentally expanding.
Which brings us to Section 2, digital assets and tokenization, re-architecting capital. We are way past just digitizing things. We're now completely re-architecting how value is created and moved around. The real game changer you need to focus on here is tokenization. Think of it as taking a physical asset, whether that's real estate, equities, or even carbon credits, and transforming it into a digitally tradable security. This lets those assets interact seamlessly with smart contracts on a decentralized network. It's opening up completely new economic models, allowing for fractional ownership and instant transferability.
So, when you're sizing up startups or allocating resources, it's vital to contrast the traditional finance world with decentralized finance. TradFi, it's heavily centralized and relies on human intermediaries, which naturally means higher fees and agonizingly slow manual compliance. DeFi, on the other hand, utilizes a decentralized architecture that is totally self-executing. It runs on programmable trust and peer-to-peer networks. You're basically swapping out human middlemen and their lunch breaks for absolute mathematical certainty.
Moving on to Section 3, blockchain in real markets, utility over hype.
Let's look at where this is actually solving real-world friction today, because the utility here is undeniable. Think about the M-Pesa mobile banking revolution in Kenya. That unlocked financial inclusion for millions using just basic mobile phones. Over in the enterprise sector, blockchains like Hyperledger are tracking complex global supply chains. We're seeing healthcare systems lock down immutable medical records. And perhaps most critically for the ecosystem, decentralized Oracle networks like Chainlink are providing the vital bridge that links off-chain real-world data securely straight into blockchain smart contracts.
And the engine powering all of this? Smart contracts. These are essentially digital protocols that automatically execute transactions the exact second predefined mathematical conditions are met. No human middlemen required. It solves what computer scientists call the Byzantine generals problem, creating a system where even mutually suspicious parties can reach a 100% guaranteed agreement on a shared record of truth without needing a referee.
All right, Section 4, the rise of agentic AI, the sovereign machine.
Here's where things get really bleeding edge. We're at the exact intersection of artificial intelligence and automated capital allocation. Recent research points out that AI is transitioning from just a basic descriptive productivity tool right into an autonomous agentic system. We are so far past simple customer service chatbots. Global banks definitely see this writing on the wall. They're actively allocating up to 35% of their total IT budgets, that's tens of billions of dollars, into integrating these AI agents into their core operations. To see how this plays out in reality, imagine an AI payment agent operating on your behalf. Step 1, it autonomously hunts down a specific currency drop. Step 2, it securely verifies user identity using cryptographic signatures. Step 3, it executes a complex cross-border settlement. And Step 4, it instantly logs all the necessary regulatory compliance data on-chain. Boom. All of that happens in a fraction of a second, entirely without human intervention. To really put the sheer scale of this adoption into perspective, predictive analytics and agentic AI systems are already driving roughly 60% of all loan decisions on digital lending platforms today. That's not some sci-fi future, it is the current operational reality of managing risk and capital right now.
Next up, Section 5, FinTech and Cross-Border Settlements, Upgrading the Plumbing.
All this automation feeds directly into an absolute explosion of digital assets acting as our new settlement rails. Get this, stablecoin transfer volumes have actually blown past $18 trillion. That volume outright surpasses traditional legacy networks like Visa and MasterCard. It's incredible. Stablecoins have rapidly evolved from just being crypto trading pairs into the default rail for instant, low-cost B2B global settlements.
And you better believe central banks are paying close attention. They're responding by developing wholesale central bank digital currencies, or WCBDCs. The goal here is to anchor these new decentralized digital asset platforms with highly secure central bank money. By settling transactions in WCBDCs, institutions get to utilize the blazing speed of distributed ledger technology, but they completely eliminate the credit and liquidity risks you'd normally associate with private alternatives.
Which brings us to our final part, Section 6, Navigating Risks and Regulations, the Compliance Mandate.
As investment pros, we have to balance this massive technological upside with a very sober look at systemic risks. We're seeing rising fraud stats across traditional credit transfers and card payments. And sure, AI can absolutely be used maliciously to power deepfakes and sophisticated scams. But there's another side of this coin. Institutions are simultaneously deploying agentic AI defensively to detect real-time fraud. They're moving away from clunky batch review processes and using self-learning algorithms to autonomously monitor transaction flows and stop cybercrime literally as it happens.
But hey, the risks aren't just from bad actors. They are deeply structural too. Take decentralized autonomous organizations, or DAOs. We have to carefully weigh their totally unclear legal accountability. If a DAO commits a regulatory violation, who exactly is accountable? Same goes for the structural fragilities we've seen in the unbundled banking sector. When banking-as-a-service middleware collapses, like we saw with platforms like Synapse, thousands of users can lose access to their funds simply because of hidden dependencies in the chain.
As we wrap up this explainer, I want to leave you with a provocative thought. Something to really challenge your investment roadmap in this age of autonomous finance. Knowing that AI agents are aggressively replacing middlemen, that tokenization is fundamentally re-architecting capital, and that systemic risks are shifting entirely, how will you allocate your resources between the legacy incumbents and the agile disruptors in this cycle? Thank you so much for joining me to unpack the future of money.